Welcome to the Rose Show podcast.
So welcome everyone, all the listeners. Thank you so much for joining us. Well, get ready to have lots of fun learning. We have a fantastic panel today with some really great people. And we'll be discussing our thoughts on macroeconomic and markets outlook for 2023, trading, crypto, options, risk, trading psychology, and more. Quick disclaimer, please do not construe this as investment or financial advice. So I'm Rosanna, and I'm here with Tom of BarChart, and Caleb, Franzen, Leah, and Archna. So let's begin. I'd like to go around and introduce our panel. Let's begin with you, Tom of BarChart.
Yeah, just so everybody's listening, Tom is BarChart, at least for today. So when Rosanna calls me Tom, it's me here at BarChart. Just a further disclaimer to what Rosanna said. Guys, I'm not speaking on behalf of BarChart. Nothing I say is BarChart approved. I'm just giving my personal thoughts and opinions on the market. But yeah, we're excited to be here with Rosanna. Rosanna, this is our first official spaces together. We've got a great panel. Caleb, Leah, Archna, super excited to get all their thoughts on where they see the market going, what they're looking at specifically in terms of stocks and sectors. And yeah, I've got my notepad ready. I'm going to take a lot of notes today.
Awesome. Likewise. Caleb, let's go to you next. Founder of Cubic Analytics, where you share macro and market analysis. Everyone should check it out. Great Substacks. And thanks again to Tom for introducing us. How are you doing today?
Yeah, I'm doing well. No complaints. Excited to be here.
Awesome. And Leah, investor, trader, and coach and published author. How are you?
Hi.
Any thoughts on anything today?
Hi there. Today I'm taking it easy because tomorrow we have the CPI. So I'm just, I wasn't day trading today. I'm just really patient. But thanks for having me here. I'm excited to spend some time with you guys and chat about 2023.
Yes, thank you for coming. Archna, fantastic options trader, and love your Substacks as well with your daily options trading and technical analysis. How you doing? How's your week been?
It's been good. The 2 days of chop, it was easy to sell put spreads on SPX and make some cash flow.
Awesome. You're always in there doing that. Love that. I can't wait to speak to you about that a little later when we get to the market segment. Let's begin with some macroeconomic discussion. As we know, CPI is tomorrow. And Caleb, I'd love to know your thoughts on the CPI, the Fed, and inflation overall. What are you thinking?
Yeah, so I mean, we're in a decisive deceleration in inflation metrics on a year-over-year basis. We've seen month-over-month readings start to come back basically towards a neutral increase, right? So a 0% rate of change. I think the last month data for headline was about 0.1. It might have been 0.2 if I'm not mistaken. Either way, right, we're seeing a pretty steep deceleration off that 9.1% print that we had for the month of June 2022. And since then, it's just kind of continued to improve. The thing that's important to realize, and I mean, pretty much I think everyone on this call recognizes this, is that the Fed knows, and everyone knows, that inflation is still far beyond the Fed's 2% target, right? And so the entire kind of macro conversation is really kind of taking place around at what level is the Fed going to start to get complacent with respect to changing monetary policy or not changing monetary policy based on where inflation is, right? And so for some people, they're debating that that's around 4%. For some, they're saying it's around 5%. I'm a little bit more stringent. And so I think, the Fed is really going to need to see inflation get between that 3 to 4% range before they really start to feel confident. Because again, the Fed has continued, and, Jerome Powell himself has continued to invoke the mistakes of Arthur Burns and the Fed during the mid 70s when they kind of let their foot off the gas pedal too soon with respect to providing monetary stimulus or withdrawing the tightening process that they were undergoing at the time. And so that's why Volcker had to come in and really kind of shock the entire economic system. And so the Fed doesn't want to shock the economic system necessarily more than they already have. This has been a historic tightening cycle by any metric that you essentially look at, right? And so the two ways that I really try to understand the severity of the current tightening cycle with respect to the federal funds rate is you can look at the year-over-year rate of change and the year-over-year nominal increase. First and foremost, on the year-over-year rate of change, we've never seen the pace rise this quickly. I don't even remember what it is off the top of my head, but essentially when we were starting this time last year, the federal funds rate was 0.08%. Today we're sitting at 4.33%, right? So you guys can do the math and figure out what kind of percent increase that is year over year. And then if you look at the nominal percent increase, if my mental math is correct, that puts us at basically a 4.25% increase in terms of the federal funds rate on a year over year basis. Again, that also hasn't happened going back to basically the 70s and the 80s. So on both of those metrics, right, we're already seeing a pretty severe shock in terms of how financial assets are responding, what's happening in the housing market, not in terms of price, but in terms of demand and supply dynamics just generally, right? So they're both at historically low levels in terms of both supply and demand. And so, you know, I'm definitely looking forward to the inflation data tomorrow. I think David Kudla put out a great tweet not too long ago, this afternoon, basically saying that he expects inflation on a year-over-year basis to be closer to 6 than he does to 7. So basically below 6.5%. And I think that's a pretty fair assessment. I'd be pretty aligned with that. I think when we look at energy price dynamics, commodity dynamics, they're all coming down, they're all cooling off. And so the big question for the Fed, at least under the hood, tomorrow is really going to be what's happening in terms of shelter dynamics. I don't necessarily expect shelter to peak probably until the tail end of the first quarter here, just because of how the shelter component actually lags the real housing market and rental market. So, you know, the shelter component makes up a third of the CPI. So when you really extract that out and look at, I think they look at the services X shelter CPI. And I think that might actually be negative on a year over year or month over month basis. So that's going to be pretty interesting to see tomorrow.
Very nice. Thank you. Yeah, per Deutsche Bank, they say once inflation goes over 5%, it can take, I think, about a decade to come back down to 2%. Now, that's one data point. They know more than I do, but I think we can all agree that this inflation is very sticky. Shelter, yes, as you mentioned, 33%. And then services, we know services are very sticky, and services are a function of employment and wages. And we know the labor market, very tight. Wage growth has been significant. And that does fuel the nominal spending, which further fuels the nominal demand. So that is an issue, a very big issue there with bringing that inflation back down to the Fed's goal of 2%. The inflation swaps market expects 2.5% by mid this year. What do you think about that with what the market may expect and what might actually really happen, and having inflation be stuck in that range, like you mentioned, 4, 5, 6%? What are your thoughts on that conflict of perspective?
So I think 2.5% is a pretty aggressive call. I don't think we'll be there by mid this year was what the prediction was.
Yes, about mid this year was what I read.
Okay, yeah. So I wouldn't put much credence into that. Obviously, there's a chance. I think it's all going to depend on economic dynamics, right? Because in the Fed's Keynesian model, there's a direct or positive correlation between economic growth and inflation. And so if we really do get a recession, but not a soft landing, right? So an actually severe recession by mid-year this year, then sure, right? We might get down to that 2.5% year over year headline CPI. We might even trend a little bit closer towards outright deflation. But you know, there's nothing rosy about that picture, right? And so it's important to provide that context as to how we actually get to 2.5% year over year headline CPI. And so, you know, from my perspective, I think that's a little bit aggressive, because I think now more so than ever, the odds of a quote unquote soft landing are probably the highest they've been, but I'd still give them a very small chance, right? Personally, I would probably say the likelihood of a soft landing at this point is probably around 10% in my book. But again, that's significantly higher than what I would have said in July, August, or even September of last year. And so when we look at the dynamic nature of the labor market, being historically tight. As far as I can tell, there are only 6 months since 1970 where the unemployment rate has been 3.5%, and December was one of them. And so, it's certainly a unique precedent to have 3.5% unemployment. And so I think you kind of hit the nail on the head. If the labor market is strong, meaning that aggregate income is really resilient, and if we look at average hourly earnings, it's decelerating, but I think the latest data showed about 4.7, 4.6% off the top of my head on a year-over-year basis. It's hard for me to take that 2.5% forecast that's happening in the swaps market with a lot of seriousness, because in a lot of ways, just from a very crude or basic metric, I think that average hourly earnings, wage growth, all of that stuff essentially kind of puts a floor under the year-over-year headline CPI level. So again, right, that's why I think for me, I get a little bit more confident feeling that we're going to be in the 4% handle at some point this year, depending, like I said, on how significantly the economy deteriorates or how much it continues to stay resilient and dynamic.
Exactly, I agree with you. Great points that you make there. The increased tightness in the labor market is placing pressure on consumer prices. So, and then we look at the other data besides the unemployment. It seems like the beverage curve and the fill rate both show maybe even less softening may suffice, because with that data, we're actually seeing that an elevated number of people that are taking jobs are not really coming from the unemployed. So there's a lot of different factors. There's a lot going on. So agree with you that, this inflation is very sticky, and we may be in for a much more elevated level than many anticipate. And, looking at the small business optimism index, which is very important to me because being in the small business world, I run a manufacturing business, I look at that data very closely. And I can tell you inflation is the single biggest problem facing our business and our industry of manufacturing. And that's exactly what they said in the report yesterday, I believe it was, that it came out. So, I want to segue to earnings, because earnings are very important for us as, investors and traders. And we look at the earnings season is about to begin soon. And what are your thoughts on the earnings pressures we've been experiencing? Do you think we could go into an earnings recession?
My base case is that we go into an earnings recession. So I published my 2023 market outlook on the 1st of January. And I really tried to provide 5 forward-looking economic indicators and data points that are all kind of flashing recessionary type signals. And so every time these signals have flashed, we've either been in a recession or on the verge of falling into one in the short to medium term, right? So basically within a 6 to 20 month period. And so considering that those variables have flashed, basically starting in July or August of 2022, we had some flash in October, we had some flash in November, we had some flash in December, so on and so forth. I do view a fairly high probability that we actually do go into a recession in 2023. And so from that standpoint, I certainly do think that we'll see a larger decline than is currently anticipated in earnings, because I think I looked at some data just the other day, and it was saying that earnings expectations for 2023 for the S&P 500 is earnings growth of between 4 and 5%. That's pretty solid. And so it's, I think, certainly anemic relative to what earnings were in 2020, 2021, and even in 2022. But, like I said, if my kind of general base case assessment is likely that we're going to be in a recession, the severity of it can certainly be debated. But I think that, like I said, I do believe that a recession is my base or most probable case. And so I generally view a 4 or 5% earnings growth for the S&P 500 this year being a little bit too rosy or optimistic. So I would certainly expect to see that come down a little bit lower, perhaps turn outright negative.
Yes, agreed. Thank you. Yeah, margins are have been getting compressed. Cost of goods sold and operating expenses are still highly elevated, and some are even rising. So we see lowered productivity and declining, output per input. I mean, overall, there's a dilution of value. So I think there's more left. And I think that, as you said, earnings recession is very possible with 2 quarters back to back of declining earnings year over year. Let's talk, you've been tweeting a lot about the bond market and yields. I love your tweets about the yields. What are you seeing with the 2-year, 10-year, and in the bond market? Could you please share with us?
Yeah, so I'm a big student of Jeffrey Gundlach, and so I religiously listened to his interviews. And several years back, I heard him talk about the relationship between the 2-year and the federal funds rate. So in February of 2022, when conversations were really starting to heat up around the Fed getting ready to actually tighten now, I really started sharing analysis comparing the 2-year Treasury yield with the federal funds rate, noting how, guys, we should really be taking the Fed seriously here, because look at the dispersion and the divergence with where the 2-year is significantly higher than the federal funds rate. Sure enough, like I said earlier on the call, we had one of the most historic tightening cycles in modern US history. And so as we look at that relationship today, we've basically inverted with the 2-year Treasury yield and the effective federal funds rate. And so in a lot of ways, that's a sign of optimism. I see Bill out there in the crowd. He and I always have great conversations on this and back and forths, lots of civil discussion, of course. And I think in a lot of ways, the bond market is telling the Fed, yeah, you guys can't tighten anymore, right? And so from my perspective now, unequivocally, the Fed has at least reached some sort of neutral policy stance based on where based on where the bond market is trading right now. The thing is, from my perspective, the Fed has said they don't want to get to neutral. They want to be sufficiently restrictive for some time. And that's a direct quote from multiple Fed officials. And so this is why, right, we're still looking at another another 0.25% coming at the beginning of February, and then most likely another one after that. And then I think at that point, the Fed is really going to reassess. And so I think that's really important to note. I think from my perspective, though, when we do look at that 2-year Treasury yield and the relationship with the federal funds rate, I could really only find one time based on the historical data on the Fed's database, FRED, where the Fed continued to raise interest rates even after this inversion occurred. And that was, I believe it was late 70s, early 80s. And so we have to contextualize this inversion dynamic, because it's really only been over the past 30 some odd years where once this inversion occurs, the Fed is done hiking rates. But over those 30 years, we haven't dealt with actual levels of inflation, right? And so the Fed has been very outright communicative that they plan to continue to keep their policy at a restrictive or tight level until inflation continues to come lower and lower towards their target. And so I think that comp to the late 70s, early 80s is really important, because it shows that there have been similar periods where the Fed is fighting inflation as their primary focus, where they continue to raise rates even after this inversion occurred. And so I think that's a really important understanding for where we are right now with respect to the 2-year. And so for me, I'm also looking very seriously at the 3-month Treasury yield, because I think as we get shorter and shorter on that duration, we're going to get a little bit closer to some level, or perhaps like an arbiter of truth. And I think the last I checked on that, it's been maybe a day now, so I haven't checked it today. Let me pull it up. But I think the last time I checked, it was trading around 4.5, 4.6%. And so, right now we're at 4.675%. And so if we think about the effective federal funds rate right now trading at 4.33, this is essentially telling us that there's another 0.34 percent to go. So, that generally fits within the rate hike that we're all expecting at the beginning of February, which is going to be another 0.25%.
Thank you so much for that. Great perspective, great points you make with that. I know that's one of your focus areas of study, so I appreciate you sharing that. Well, I think it's a good time for us to take that information and apply it to the markets. And let's open up the panel now. Thank you so much, Caleb. We'll come back to you. Archna, could you please tell us what you're seeing right now in the markets? I know you watch daily, you're a technician with the markets. What are you seeing with the levels?
The way I'm looking at it, we consolidated for so many days, almost 2 weeks, at around that 3,800. Unless and until we don't break that, we are looking at testing 4,200. It may take time, but I am not looking for um, bearish trades until and unless we break SPX 3,800. Every time we've tried to do that, it gets protected. I mean, so whatever is happening underneath, I am selling put spreads or anything until and unless we don't break SPX 3,800. That's how I'm looking at it in terms of SPX. If inflation comes down, the rally that we have in Qs will continue. So it is more of that. I mean, you can look at all this UPST and all the ones that, the growth ones, they're all rallying today. So that can have a few more days of chasing. But ultimately, it's going to be the earnings of the big tech that will tell us whether we break that 3,800 or no.
Seems the only certainty is uncertainty at this point. Thank you so much, Archna. Leah, what are you seeing with your trading and your thoughts on the market?
Yeah, I also think that the expectations for tomorrow CPI around 6.4, 6.5. I mean, on most of the banks, they are predicting lower than that. I think if it's below 6.5, you're going to probably have massive rally that again can be, it can turn its course with the earnings of big tech. Friday we start bank earnings. I'm a little bit skeptical. Some banks maybe will do better, but some of them I'm actually betting on short. Of course, it's not a financial advice. Please don't follow my trades. I just feel like with the interest rates and the mortgage, everyone basically canceled their mortgages, so their earnings might be a little bit lower than expected. So that's like my expectation there. And then back to the CPI, if we go higher than 7 or closer to the 7, then of course it's going to be a disaster for the market. We're going to turn super bearish. And if we stay around the 6.5, we might have a continuation of this rally, not as violent as expected if it's below. And yeah, I will play it by ear. As I said, tomorrow morning, 9 a.m., I think it's the time. And yeah, we'll see what happens. I have some short positions, some long, and I just think just having some cash left for the future is not a bad idea. And, when it comes to the inflation, I just wanted to add that one topic we didn't cover is the energy, because I feel like energy is also a huge part of the metrics. And because the administration that we have now sold half of the strategic petroleum reserve, that also helped with the oil prices and that also helped with inflation data. But I'm just thinking what happens when the petroleum reserve starts to get refilled. Maybe the crude and gasoline prices will go higher, and then we will have energy inflation back. So I'm not calling it a win quite yet. So let's see what happens. That's just one topic, because I've been in oil for over a year and I'm paying close attention to oil. I don't think that oil is done quite yet, and it was a huge part while the inflation numbers also went down. But again, as we said, the problematic metrics there are truly the rent and the food, and that will be much harder for Fed to battle without actually affecting consumers. So I also think that we're going to have, it's not a question of when, of if, but when we're going to have a recession. I think that it's going to happen probably Q2, Q3. And soft landing, it's a possibility now, but if we have some bad news in that time of the soft landing, it might be even a hard landing. So that's just my opinion on the whole thing.
Thank you so much. I love you bringing up the energy point. Very important. If Tom, if you'd like to add anything to energy, or just your take on the market, or Caleb, anyone want to speak about energy, or Archna, please go right ahead.
I actually wanted to pose a question, and this is for Rosanna, Caleb, Leah, Archna. Dow Jones, I posted this in the nest, but if you look at the chart of the Dow Jones, it actually broke the downtrend that was started in January, got above it, came back, tested it as support, held it, and then bounced up again. S&P doesn't show the same thing. It's still below the 200-day, still below the downtrend. it's tried many times in 2022 to get above it, never quite was able to. So I'm just curious what your thoughts might be on sort of that difference between the Dow Jones and the S&P 500. John Rowland and we talked about this a little bit, and our conclusion was that people are still generally afraid of the markets. So there's a flight to quality, kind of chasing really high quality names like Merck, McDonald's, Chevron, names that have just been around for a long time and are battle tested. But curious if you guys have a different take or what your thoughts on that might be.
Excellent question. Go ahead, Caleb, please. Thank you.
Yeah, thanks. And, I think it's a great question because it's something I've been super focused on. Basically, since the third quarter, we've really just seen the Dow and value, generally speaking, outperform the rest of the market. And so this was usually for me a sign of caution because typically during a bottoming process, riskier segments of the market are going to lead it higher. And that's not what we saw at all. So with the Dow leading, right, that really just does highlight the rotation into value and high dividends. Investors seem to still have some form of an appetite for risk assets, but clearly not enough to move that far out onto the risk curve. And that's generally what we would expect to see when the cost of capital is gotten this high and our dollars are more scarce, right? So investors today have the opportunity to go and lock in a 4.3% yield in a money market fund. Why would they forego that opportunity in order to take on excessive risk? And so if they are looking to take risk, they're looking to take on a minimal amount. And so it's not surprising to see why we're continuing to see rotations into value and high dividend, because generally speaking, those are still going to offer some degree of a quote unquote guaranteed return in terms of the dividend. And so I expect to see that dynamic play out. Tom, I think you mentioned a great point there, which is that the Dow, at least up until this point, is the only index to have reclaimed that 200-day moving average. For me personally, I like to add both the exponential and simple moving average onto my charts and create this cloud of dynamic support and resistance. And so for me, I did a post about this, I think it was last week, highlighting the fact that the Dow retested that 200-day moving average cloud as support, and we've immediately rebounded off of it. Historically, if the Dow can stay above that 200-day moving average after bouncing off of it, it's a pretty good sign for risk dynamics and market dynamics going forward. And so I think for a lot of traders and investors right now, that should really kind of be the line in the sand for all of us, especially if the S&P and the NASDAQ can follow and get above that 200-day moving average.
Thank you. Leah?
Hi, yeah, I just think that the same thing, like the industrials are pretty powerful, and I also have some of them for the next year just to be safe, and a lot of them also provide dividends. And as I mentioned on my Twitter wall, like last week, there was 112 billion worth of inflows to money market funds, and there was like a huge amount of outflow from SPY and NASDAQ ETFs, like a VOO, SPY, QQQ. So the money, people are most likely getting really tired of the markets because the markets just can't decide what's going to happen, and people feel very insecure. So it might be that also as psychologically, a lot of people are flocking towards these safe value stocks, which is interesting because maybe it should be the other way around. Maybe it should be that now we should be flocking towards the underpriced tech stocks. But you know how human psychology works. We see like a lot of people, they've been in tech, start asking now, or should I go from tech to CAT and McDonald's? And we always think, if you're not a professional trader, you will always think a little bit late, as you should do this. So that could be also the reason why we see Dow performing so well in the last 3 months. I think it's been like 3-4 months that Dow was doing really well.
Yes, exactly. Agree. We had this discussion actually a few months ago when we were witnessing the Dow. And I remember I spoke with you, Tom, actually about the SPYV, that's the SPY, the value, and the SPYG, the SPY growth, and the ratio of those two. And it's been a positive ratio. And that's reflective of the Dow appreciating, again, being higher and doing much better, holding up its averages over the other indices. It's because there's a flight to value. Cash is king. Fundamentals matter. People are looking for that cash, the dividends, as you said, Leah, and they're moving away from the higher multiples and growth. I mean, in this environment of, overall lower growth, high inflation, more debt, less liquidity, and that's the key. It's a less liquidity. A lot of these companies that require refinancing or repurposing, reallocation for increasing in their capital and their debt with the rise of cost of debt and capital, people are afraid of investing in those, and they've moved away from that for good reason. I mean, there was a lot of free money 2 years ago. What is it now? 3 years ago, almost 3 years, 2020. There was a lot of free money. And what that did was that caused people to go to riskier assets. And so now there's like a backlash of the other way. So now people are having a flight to safety. So I think this phenomenon could possibly continue into this year. I don't know. I'm not in the business of predicting, but it's possible. And I had this discussion with an economist actually recently, and he was thinking that it could very well go on to this year. So we'll have to watch and see if the Dow remains the leader going forward. But very interesting. Excellent question, Tom. And would you like to add anything else, Tom?
Yeah, I can say my views actually.
Oh, but please do, Archna, please.
Yeah, I think that for this coming quarter, I think the Dow actually underperforms. It was a rotation. Everybody wanted to be out of tech. Where would they, put the money? So they put into UNH and all the Dow stocks. And that rotation has taken place. Now, with inflation coming down, everybody now realizing that, oh yes, year over year, we are coming down. There may be some rotation back into tech and maybe bring the Qs to around test that 300 round number. And Dow doesn't do much, especially if any of the big tech earnings are okay. QQQs can test the 300. Dow doesn't perform. Everybody gets confused. So the way trading is not only about technical analysis for me. It is about thinking, what can trip everybody's thinking, because the market tries to fool the most number of people. So I'm like, everybody is out of tech. Nobody wants Apple and Amazon. And we start getting into that because either somebody's earning is good and everybody will be confused what to do now. They will try to get back into tech, and then we go back to the same last year thing. Second half of the year, go back to Dow again. Something like that will be going on, but I don't want to buy UNH here. I'm sorry, I'm not buying that.
Thank you.
I love that
That's
stock.
funny.
Actually, I think it's safe.
I know.
I like UNH.
I love all the different perspectives here. This is fantastic. You're getting a whole full rounded views here. So you like that stock, Archna doesn't.
But I think she's right. It's just how it works.
Mm-hmm.
Like at the point that the regular retail investor realizes that, oh my God, the Dow Jones stocks are rallying. Let me sell my tech. The tech is already done. And they're selling low and buying these overpriced industrial stocks, hoping for like dividends. But then the rotation happens again. And then once you're trading actively, you're going to see those rotations. But the regular retail investor usually doesn't. Because I know I'm dealing with this. Like I have people calling me in their 60s, 70s, friends of mine, and asking me like, oh my God, should I sell my Apple and buy McDonald's? I'm like, well, McDonald's is pretty overpriced right now, but that's how the human psychology works. And that's why a lot of people lose money when they do this on their own. And yeah, so.
Agreed. Yeah, that's how it works. And that's why it's not an easy process. And otherwise,
for second
right?
half, you can buy Dow stocks again. I'm just saying for the next couple of months, I don't want to get into the Dow stocks.
No, they're pretty overpriced. Besides Boeing, maybe. I'm in Boeing. Like I think that Boeing is surely beat up for so many years, but otherwise, I'm also staying away.
I mean,
yeah.
Boeing, it went from where? I mean, it's come up so much.
It did, yeah.
Already.
Yeah, I've been in Boeing for a while, but still.
I mean, I had bought it around 130 or so. I sold it. I'm out of Boeing.
I'm sitting in. I have my long-term plan on this one. I mean, if you have it in trading account, maybe, but I hold it in my long term. Like I've been really in Boeing for a long time. It could be over a year.
I mean, its low was at around 121,
Yeah.
122, and it's almost 100 points up. So, I mean,
Yeah, just see how it reacts. I mean, if you look at the long term, like look at the weekly chart, it's still pretty low to what it was before. And, all the airlines are going to need new planes soon. Like a lot of planes are truly outdated and there is not much to choose from. I truly don't think that US airlines are going to be buying Airbus. So, like trade it, be careful, have a stop loss or like trail stop. But I think that you see it on weekly, there's the 100 moving average. So that's about 230. I think that it could potentially get there.
Great ideas. One to watch, Boeing, everyone. I love this discussion about the markets. I want to go into crypto because Caleb, I know you had a great tweet. You actually had a few tweets this week regarding Bitcoin. Archna, Leah, Tom, all of you this is a panel discussion. Chime in anytime you'd like to add. We want to hear from all of you. Caleb, I'm referencing your tweets this week about Bitcoin. What are you seeing in Bitcoin right now that's of interest for all of us?
So, we're making higher lows on a shorter time frame here in terms of dynamics that have taken place since the FTX scandal early mid-November. So, I mean, look, we're essentially looking at a month and a half to 2 months of extremely low, if not historically low volatility and a slight uptrend. That volatility is kind of picked back up now after Bitcoin was basically stuck in the mud between, let's call it 16.4 and 16.7 thousand. And so this recent kind of uptrend is pretty consistent with what we're seeing across the entire risk asset markets, right? So it shouldn't really catch anybody by surprise, I think, especially as concerns around FTX and potential contagion events kind of start to glimmer out into the distance. People aren't really as concerned about that anymore. And so, I'm not really surprised to see these dynamics. What I will say is, looking again at price structure, I see pretty significant kind of overhead resistance here in, let's call it the $17.6 to $19,000 range, which was the low wick in June of 22 to the low close on the daily level during that period. And so for me, that range, that $17.6 to $19,000 range, acted as support for almost the entire second half of the year. We bounced into that level 7 or 8 times and rebounded perfectly within it every single time. Now, what's happened since we broke below it? It actually acted as resistance. And so, as all the traders and technicians on this call will know, former support can become current potential resistance, and that's already taken place. So as we re-enter that zone, we're in it today. I think that there is reason for concern because we're in a proven zone where there's a lot of price memory and probably a lot of volume has been transacted within that range. So that's really what I'm focused on from a short-term perspective. I'm not looking at 2-hour candles, 4-hour candles, anything like that. So on a daily level, when I zoom out even further and look at something like the Williams % R oscillator on a 12-month basis or a 24-month basis, we can even look at the 18-month basis. What we're seeing is unequivocally from a statistical perspective, Bitcoin is severely oversold. And in the past, when we've gotten down into these levels, with the Williams % R oscillator falling beneath that lower bound, essentially the oversold threshold, these have been wonderful accumulation periods for long-term investors. And so, for me, I've been happy to buy around these levels. Since the whole FTX situation has happened, I was very unsure about what the future was going to hold for the broader crypto markets. So I did pause DCA, but essentially all the purchases that I've made in 2022 were between the $17,000 and $21,000 range. And I'm happily kind of sitting on my hands here. Again, just kind of letting the dust settle. I don't see any need for haste or the need to rush into the market. Even though we can look at some of these long-term indicators like I referenced, there's like 3 or 4 that I could just rattle off, but I want to give other people a chance on the call to speak. But I can have this kind of long-term understanding that we're in an accumulation zone, but still feel the need to have patience as I continue to accumulate.
Thank you. Tom, please.
Yeah, I mean, I'm pretty much in complete and total agreement with Caleb. And Caleb, we laugh about this, but you you and I are, every time we do a crypto space, we're kind of thinking along the same lines, I think. Um, if this was a normal crypto cycle in terms of like the macro conditions and easy money and low rates, I would absolutely be telling people start loading up on crypto. That's just my belief. This would normally be a great time to start buying. But with the uncertainty in the overall market, the concerns about crypto contagion, it's still not over. We still have the aftermath of FTX. We've got potential issues with Silvergate. Who knows what else might creep up. There still is a bit of overall uneasiness about entering the market because, of course, nobody wants to buy Bitcoin at 17,000 and then watch the bottom fall out to 11 or 10,000, a few weeks after. So I understand that. If you're in this for the long game, and I'm not trying to trade, a week here, a week there. I'm in it for the full cycle. So you have to ask yourself this question: does it really matter if you buy Bitcoin at 17,000 or 14,000 when you know the type of returns that can be realized in the space? And if you're somebody who's sitting on a decent size portfolio, yeah, you can absolutely be patient. You can time your entries. But if you're sitting there without any crypto exposure and you're having trouble sleeping at night because you're worried that you're going to miss the rocket ship, you should really be DCAing into the market because you just never know. I mean, this potentially could be the bottom. And then, the worst thing you can do is watch Bitcoin explode one day to 25,000. And then you start buying at 25,000 because you don't have any exposure. And then the next thing you know, it's back to where it was. You have to really kind of think through this and come up with a plan that fits your risk and your goals. So those are just my thoughts. I get a lot of questions too about altcoins. I wouldn't worry about altcoins right now, and that includes Ethereum. I would just focus on Bitcoin because the first step in identifying like a new potential crypto cycle is, has Bitcoin bottomed? Altcoins don't bottom against Bitcoin until at least 6 months afterwards. So focus on Bitcoin, try to identify what's going on with that, and then focus on the altcoins at a later point.
Thank you so much for that. Archna or Leah, are you a Bitcoin investors or anything? Leah, please go ahead.
I have some questions. So I've been in crypto since 2016, and I got out of majority of my crypto last year. It was sad goodbye because I just really didn't like what was happening this year. So I have hurt feelings. I made a ton of money with crypto, then I lost some money with crypto. I still love the idea, but I'm not so sure if I want to go back and when. I have questions for you guys. Like you seem to know this really well, but what is worrying me there is the situation of the economy and the markets. Like, the quantitative easing started in November 2008 and crypto was born in January 2009. So I'm just wondering, like, isn't it that crypto was actually born because of the excess liquidity? And this time we have liquidity issues. We might not have excess liquidity to invest into crypto. And when we are talking about Bitcoin, I mean, I love Bitcoin, but what is the potential there really? Like, we don't really know much. Like, isn't there a potential maybe in some little like small caps and growth stocks that are probably safer and you can play options on them, and you can also make 300-400% on some of those. Like, we see this massive rallies that are happening, and once we have confirmed bull market at some point, I think that there is also potential in tech. So I'm just like really in between right now. Like, I don't know if it's because I got so burned last year with all the Celsius and Voyager and FTX situation. I didn't have money in FTX, but I had a lot of my Bitcoin in Celsius, which I lost. So I'm just like really in the middle right now. What do you guys think about that?
I mean, I can go first. Yeah, I agree with everything you're saying. When 2022 finished, I was mentally exhausted of crypto. Just all the issues, not only the declining prices, but then all of these really, really bad actors in the space, and it's frustrating and it's depressing, and I understand all of that. If you look back in history, each crypto cycle has had its own share of problems. I mean, if you go back way in time, there was Mt. Gox. Mt. Gox was a bomb in the crypto space. I mean, so many people just lost everything and they still haven't recovered, their assets. And there's always a question of regulation. The question of regulation is not new this cycle. It's been going on for a long time. It's just maybe more at the forefront of thoughts because, the valuations of crypto have gone up and there's more participants in the space. So there's more talk about it. I don't think 2023 is going to be a great year for crypto by any means. Okay. Bitcoin's not going up to 50,000 this year. It's just not going to happen. I think it's potentially an accumulation year. So I think you're going to see a lot of sideways action while people kind of continue to watch the overall macro conditions and just get a feel for what's going to shake out over the coming years. But I don't expect much in 2023. I just think it's a decent period to get back into it, kind of dip your toes into the market. I think potentially the fourth quarter of 2023 could be interesting. I think 2024 is definitely going to be interesting. We've got the Bitcoin halving in the spring, and typically that coincides with some pretty strong price action. There's also this kind of idea of a 16-year asset cycle. So we've already had 3 crypto cycles. We're about to enter the 4th, and that might coincide with a left translated cycle. So we've had 3 right translated cycles. Now this one might be a left translated. What does that mean? Well, that means that typically crypto cycles last about 4 years, but potentially this one finishes up a bit quicker than that. So, a lot of people are kind of with the idea that 2025 might be when you have sort of that really, really strong bull phase. I think it might come a bit sooner than that. Now, of course, again, this is Bitcoin and crypto's first really recession test. So it's uncertain. Again, there's a lot of uncertainty. That's why you're seeing a lot of people saying crypto's over and Bitcoin's dead. I get it. It's a tough time, but I don't think so. I just really don't think that. I don't think that the space is dead.
No, I agree with you. I don't think so either. I think it's not that. I'm just curious, like maybe it's going to take longer this time because of the recession and the quantitative tightening. That's just like more my worry.
Yeah, and I think I do think it could take longer. I think the other idea too is that there's this idea of diminishing returns. So every crypto cycle, you can expect to earn less and less in terms of returns, because as valuations go up, it's tough to continue generating 100x returns. Mm-hmm. We didn't really get that sort of mania explosion phase in the last cycle. A lot of people were expecting Bitcoin to go to 150,000, 200,000. It went to 69,000. And
69. Perfect. Yeah.
And I think that was potentially cut short because of the macro headwinds. Mm-hmm. I really feel that way. So I think the next cycle could actually be really, really exciting. Just my gut feeling on that, because the last one was cut short. So my overriding message is I would not want to be sitting out for the next bull cycle, whenever that comes. Who knows when it's going to come, but I would not want to be on the sidelines for that. And
you don't like Ethereum? Are you in Ethereum as well?
Oh, I really do like Ethereum. Yeah, I really do. I just know that, and actually, I'm really impressed with what Ethereum has done. It's held up really, really well. If you look at past cycles, it's fallen off whenever the crypto goes into a bear market. So it's done a great job, and I think that has something to do with the proof of stake and the upcoming Shanghai protocol. But yeah, I just know that Bitcoin's going to bottom first. I just know that. That's always how it happens. Bitcoin bottoms. Bitcoin is kind of the reserve currency, if you will, of the crypto space. So Bitcoin bottoms first. Once people are comfortable that Bitcoin has found a bottom and they've kind of ridden that up a little bit, maybe generated some gains, then you'll see some capital flow into altcoins like Ethereum and maybe Cardano, coins of that nature.
Yeah. Thank you.
Thank you. Caleb, would you like to add something as well?
Yeah, I would, because, I think Leah makes a great point referencing liquidity dynamics. And so, I've done some statistical tests on this and looking at relationships, right? And so one thing that's pretty interesting, if you think about liquidity really influencing bank reserves, right? I mean, that's pretty unquestionable. When the Fed goes out into the markets and they start buying treasuries and mortgage-backed securities, they're buying those assets from commercial banks in exchange for a reserve asset. So as the Fed continues to conduct quantitative easing, reserves are going to rise as a function of that. And so there's a pretty interesting relationship where you can track reserves. And what you can do is you can overlay, Rosanna, you talked about this earlier, but SPYG over SPYV, I think is what it was, basically looking at growth versus value.
Yes.
And so
yes.
as reserves are rising, there's a very key relationship where growth is going to outperform value in perfect lockstep with the trajectory of reserves. They move perfectly in line. If you go to my profile right now on Twitter and you look at my pinned post where I'm sharing my 2023 market outlook, that's the chart that I'm referencing, right? And so we can see clearly a relationship between high beta versus low volatility and reserves. And so Bitcoin has also a very direct relationship with that variable. So we can compare Bitcoin versus something like the S&P 500 high beta ETF divided by the S&P 500 low volatility ETF. And once again, we're going to see this same dynamic. And so, yeah, 100%, Bitcoin is just a function of central bank induced liquidity dynamics. And so, again, that's why I'm not super optimistic to be continuing to pour money into Bitcoin right now, is because I still see a lot of headwinds in terms of what's happening with reserve dynamics, right? Because we have to think about it as now the Fed shifts into quantitative tightening, as they actually start to sell and reduce the size of their balance sheet. What's happening there? It's the exact opposite relationship that they're doing during QE. So they sell, basically they sell their treasuries and mortgage-backed securities, and they take away the reserve asset from the commercial banks. So my baseline projection is that reserves are going to continue to fall in 2023, which means based on those historical relationships that we just went over, the price of Bitcoin and growth relative to value should be on the decline as well. And so, Leah, you talk about having an extended bear market. I think that's certainly the dynamic that we're going to have in play, right? And so the big debate comes in, which is, a defining characteristic of bear markets is that we're going to have relief rallies. We are always going to have a counter trend move, regardless of which way the trend is going. And so for the past 12 plus months, we've unequivocally been in the downtrend. And during that time, we've unequivocally had significant bear market rallies. And so I expect those to continue. I think that's what we're in right now. And so the magnitude and duration of those rallies can certainly be up for debate. It could end tomorrow, right? We don't know. It could end 2 months from now. Again, we don't know. And so staying flexible and dynamic in this market is really important, but I think it's vital to understand the dynamics that are being impacted from the reserve side and the quantitative tightening side of the equation.
Agree. Thank you. Yeah, I think liquidity is a big issue when it comes to crypto. To many people, I think it's my opinion personally. I am long-term Bitcoin. I have reduced position sizing, of course, maybe scaling in over time. But I do think it is seen overall as having no real value to it. And many people discuss it that way. So with tightening liquidity, it makes sense that that would directly affect crypto and Bitcoin, and especially all the altcoins. So great points everyone's making. Thank you so much. And Caleb, as you mentioned, the SPLV, low volatility, I watched that closely with the SPHB, the high beta, and we can see that as well, how the low volatility has been increasing and the high beta has been decreasing. At the same way that we look at SPYG, I reversed it. It's growth over value is what I usually do. And that's been declining since I believe early December 21. I posted that chart a while back, and I think I tweeted about it again recently. But that has to do with that Dow effect against the NASDAQ. I love this crypto talk. I think it's great. I want to really talk about what we're doing. All of us are doing in this market. It's a difficult market. I think that's an understatement. It's a very challenging time for all. And Caleb, I'd like to begin with you this time because you tweeted how your trading account is currently 65% long. And You have cash as well, I think 28%. I think this tweet was yesterday. And I'd like to know what you're doing. How are you aligning yourself? Which asset classes are you bullish on? And what is your long positioning in, if you don't mind me asking?
Yeah, sure. So I think it's really important here to bifurcate between two different portfolios that I have. One of them is obviously a long-term investing account. Another one is more of an active kind of trading account, right? And so in that tweet that you referenced, I'm really focused in talking about my trading account. So I'm happy to share exactly what I'm invested in. I've been sharing it already on Twitter, just via post, but I'm happy to kind of explain a little bit more of what I'm seeing here. So essentially how I've structured this is I'm long Tesla via TSLL. It's a 1.5x leveraged long Tesla ETF. I have that position. I think it's my largest size right now. Second largest is YINN. It's a 3x China ETF. As I look at China market dynamics, right, they're continuing to provide a lot of monetary and fiscal stimulus. The reopening dynamic has been on and off for well over a year. And I think that kind of trend of, we're reopening. Oh, we're not reopening. We're reopening. We're not reopening. I think that's going to continue this year. And so I think as we kind of have these reopening narratives come in, I expect to see bullish dynamics for China. And so, especially as they devalue their currency, right? So the value of those assets should go up relative to their currency so long as they are devaluing the currency. And so I am long that 3x China ETF as well. One position that I did add during yesterday's session was FNGU. It's a 3x leveraged NYSE FANG Plus Index ETF. So again, this is going to be, it's an equal cap weighted index of the 10 mega cap tech stocks. All the names everyone's familiar with: Apple, Microsoft, Netflix, Google, Meta, Tesla. I think they actually just recently took out Alibaba and Baidu in replace of two other individual holdings, and I forget what they are. Either way, I'm also long that as well. All those positions are positive. And then on the short side, I'm still long SOXS. It's a 3x leveraged inverse semiconductors ETF. I had sold a lot of that position already in profit, and I'm still holding a very small amount, especially relative to the rest of my portfolio, but it's deeply in a loss now. So I'm down 25% on that, but I'm not selling it because I've hedged it with those long positions. So the loss on that remaining portion, I'm still net positive on the entire trade, which is why I haven't really been in a rush to sell it. And I think especially as we go into CPI tomorrow, I still do want to have some downside exposure, just kind of offsetting what I'm already long. So it's a marginal position at this point again, so it's fairly insignificant. But right now in my trading account, those are the four open positions that I have at the moment.
Thank you so much. How about commodities? Any metals or gold, silver, any of that, Caleb, or anyone else after you?
In terms of commodities, I'm not playing anything. I know a lot of people have been really focused on gold lately. I did a tweet about that this morning. It's just really important to remember gold is inversely correlated to real yields. And so real yields have really taken a nosedive over the past, let's call it 2.5 months. Because inflation expectations and actual inflation have continued to stair step lower. And we've also seen yields kind of come back down in line as the bond market really starts to price in what I view as a recession. And so real yields on the aggregate have really taken a nosedive, which is what's causing, in my opinion, gold to pump up a little bit more. I don't necessarily know how long that dynamic is going to persist. And even if it does, right, gold really doesn't offer too much upside from my perspective relative to other sections of the market that would benefit from real yields falling. So I'm avoiding gold and commodities in general.
Thank you so much. I love that perspective. It's always great to have diverse opinions, valuable input. Archna, what are you doing these days regarding your trading? And what are you looking at? What are you bullish or short on of anything?
Yeah, I'm more of a day trade to swing trade. So I have been long Amazon, especially on, I was selling puts in Amazon last year when the volatility was high. I sold puts on Amazon. I sold puts on Tesla. I sold puts on PGNY. Anything that I wanted to get long, I sold puts. And last 2 days, when the volatility has gotten to almost 20, I'm out of them. I have now cash to reload if I need to. So that's what I was doing. I didn't put any of the stocks because I had sold Amazon 80 puts and I had sold PGNY 30 puts. So it's again above that. I had sold GNRC puts. I did not mind getting long these stocks. So that's how I traded. And I use BarChart for screening and coming up with stock ideas. And I have been long BOOT, since 65. And that was a scanner. I mean, it showed up on BarChart one day, I think 2-3 days ago. And it's country wear, kind of apparel company. And with election coming up, maybe it's time to buy cowboy hats and everything. So I'm long it. I'm long boot. I see it going at least to 80 or so. So from 65 to 80, not bad. Then again, yesterday, if you look at the scanner that I used, is they have today's top stock picks. And so from there, if I look at PD, PagerDuty, is another one that looks good. So I am long PagerDuty. It's a growth tech. It is in cybersecurity, I think, but its technical chart looks good. So it is consolidating above the Bollinger Band on the weekly. If it closes above 27, I don't see why it can't get to 30, 32. So that's what I'm doing. I'm having some small short positions here and there, but I am playing very small because earnings are there and it's a hit or a miss. You don't know. Everybody is expecting something and something, Netflix down 25%, Target down. Those kind of moves that happened last year, we may not have this time, but I don't know what happens. So I'm playing very small now. I have a lot of cash because some of the short puts are already, 50% profit and I'm out of them.
Very nice. Yeah, take your profits when you have them in a bear market. I agree completely. I'm trying to remain as liquid as possible with my cash position. Leah, what are you doing? I know you are an options trader and you've been doing some options trades. Could you please share with us your thinking on how you're playing this difficult market?
So I was irresponsibly long the whole year. I've been invested in the market for over 10 years. So I just have always core long positions. And now I have probably 30% cash that I actually have in money markets, which is great. Getting over 4%, 4.3, like almost every bank or broker will offer you a good amount these days, which is amazing in comparison to last year, as we said. And yeah, I also was accumulating big tech. My biggest tech position is actually Amazon as well. I'm just accumulating on really bad down days when the fear index is very low. That's when I usually load the boat and just hold on to it. I'm not selling these positions. I'm holding them for a long term. That's why even with the Boeing, I'm not suggesting people buy it now, but I believe that Boeing can get much higher over a longer term. I think when I'm talking about longer term, for me, it's about 5 years at least. And also I have a fair amount of high dividend stocks that I have. Like I have international dividend stocks, international REITs. I have some on Singapore Exchange, Hong Kong. I have some from UK. When UK was doing really poorly, those REITs were actually super undervalued and the dividends are really high. So I'm still sticking with those, which is getting me like my return on investment on my dividend stocks is about 6.6% a year, which is quite nice. I have different ones like natural gas, oil. As I said, I don't think oil and nat gas is down quite yet. Maybe now we have a little bit drawdown with the overreaction to warmer weather in US and Europe also. Europe is super warm for winter. So that's like kind of my thing. Well, money market, dividend stocks, and accumulating the quality growth stocks. And for trading, I trade pretty much anything. I would even trade BBBY, because it's in and out, very strict rules for stop losses. And it's pretty much, I love trading Tesla. I was trading Tesla literally almost every single day these past 3 months. I was shorting it, and then I took it long, and I sold some puts. Today I actually got out of my 115 puts I sold last week's. So yeah, that's pretty much my strategy, and I'm going to remain like that for 2023. Still a little bit careful, on a careful side. So I will keep my cash and see what's happening. But again, we might get to recession, but recession doesn't mean the market. Oftentimes in the past, we were in recession, the market was already correcting higher. So we'll see.
Thank you. Tom, are you, besides watching Bitcoin as closely as you do, are you trading or doing anything in this market these days, and any plans you have?
I'm actually mainly in, you guys are going to laugh, but I'm mainly in T-bills. I've been in T-bills for a while, 4 weeks. I've just set up a ladder so that I can have the money available every week if I see an opportunity in the market that I want to deploy capital to. But mainly collecting just that interest, 4% on 4 weeks is pretty solid. I do have a few positions. I've got Occidental, which I acquired actually pretty recently. It was kind of close to the range that Warren Buffett was buying in his I believe August, when he was buying his last position. I just really like the name. I'm long energy well into the future. So I believe energy stocks are going to perform well, over the next 3 to 5 years. Whether that happens in 2023, I don't know. I'm a little nervous. I posted this in the Nest earlier, but in November, and it's still the case now, although it's narrowed a bit, there was a divergence that formed between energy stocks and the price of crude oil. So it hadn't happened all year. It happened, I believe in October, November, December. So it makes me a little nervous, because what does that mean? Does that mean energy stocks come back down to match the price of crude, or does crude come back up and match, where energy stocks are at? I don't know. But I do believe in energy stocks over the long haul. So I've got Occidental. I've got a small position in Peabody, which I've had for quite a while. I think coal names are going to do quite well. And I've got silver. So I'm playing silver through an SLV Leap. Very small position at the moment. I just kind of liked how the charts were kind of shaping up. I feel it in my bones. This is not investment advice, guys, but I just feel it in my bones that metals are going to do quite well over the next 1 to 2 years. I just feel it's their time. So I've got a small position. I'll add to that as it materializes and as the charts continue to line up in a way that I think makes sense. But yeah, mainly in T-bills, waiting for new opportunities to develop, waiting for some clarity on the macro and the CPI situation before I really get long into the market.
Great thinking. Thank you. I also am T-bills. I do the 4-week ones as well. I'm holding a good bit more cash than I usually do. But I'm also commodities. I have gold and silver. I have copper. I actually added copper futures. I got lucky. I did it Monday morning. But I am long metals overall for this year, especially with stagflation as a possibility. It seems very likely, actually, in my opinion. I'm not an economist, but in my opinion, it appears to be so. And so commodities tend to do better in that type of environment. So I trade them via the ETF as well, just like you, Tom, SLV, and I think it's GLD. I have options on that as well. And cash, remaining liquid to seize opportunities, because there will be many. The rubber band theory people talk about, as far low as we go, we're going to swing back up even higher. So it will, you look at the charts overall, that we go higher, and we just don't know when. So just staying positive, knowing that opportunities are forthcoming in the future. So just remaining liquid. I'm still holding some long positions from a long time ago. Once you're long, like Leah said, she's been investing for 10 years. Once you're long many years in a stock, you hold on to it. Of course, you have your own strategy, your risk management on that. But and I do options around my positions. So, just stay positive and know that better times are coming up ahead. Risk management is very important. This is something people say, oh, I should have done this a year ago. It's never too late to discuss risk management. So, and also trading psychology. It's about mindset. They say about 70 to 80% of your trade is your mindset. And it's not just about your skill set. So it's very important that I'd like to touch upon those issues as we wrap up this space. We have some great people here, and I'd love to hear all of your inputs. Archna, would you like to begin with that discussion of risk management, your mindset, and trading psychology, please?
Yeah, of course, risk management is the most important, and knowing how to trade around your position, and when you get into the trade, you need to know whether it's a day trade, swing trade, long term, because that affects a lot of how you trade. I mean, I was long Amazon by selling puts because I did not mind getting long that. But then you have to realize that if you're selling puts, there are times when, um, like Netflix gaps down 25%. If you were short puts in Netflix last year, um, you know, because of that gap down, even your short puts, oh, I don't mind getting long Netflix, you would have gotten stuck in it. And you need to know how to sell calls against or some kind of strategy to be able to get out of it. So, especially selling puts or something like that, I don't do over or do not take it into earnings. I make sure that I'm out before that. Um, so all those things are very important, and knowing some strategies. If you There's no harm in doing a call debit spread, which is kind of a lotto trade for earnings if you want to take that as a trader. But so in that regard, it's just the debit paid that you are losing, not margin or any of that. Make sure that you at least don't get margined out of a call that you wanted to take. So very important to have cash, very important to know how much risk you have. And there are tools, um, option strat, bar chart, think or swim, all these tools. When you put in an options trade, even if it is having a strategy that may seem complicated, it tells you what's your max loss and under what condition that max loss can happen. Think or swim, you can even, and tasty works, you can actually forward, you can put price slices in it and go forward. If there's one standard deviation move, what would be my loss? If volatility increases by 5%, what would be my max loss on that position? So you could do all that beforehand you get in. So analyzing the trade is an important skill in itself. And if you know that, risk management becomes easy.
I like that. I like to say it's simple but not easy. So, but you explained it so well. Thank you so much, Archna. Leah, I know psychology is one of your specialties, and trading psychology as well. If you could discuss your risk management and your trading psych, would be great. Thank you.
Yeah, so I think that this was a challenging year behind us, 2022, and this year probably won't be different. So I think just having your emotions in check is the most important. Have a plan. Have a plan how much money you want to allocate into stocks. Have a plan how much cash you want to keep. Look at the chart and say, if SPY gets to these levels, this is what I'm going to deploy. Write it down and stick with it, because we can have all the plan we want, and if we see the charts moving, and the worst are the news and then the analyst reports. Like I don't listen to any of this. Like I have my core 20 companies that I believe in, And I look at their earnings reports, and every quarter I check with myself and see if I'm still believing in the company. And then I'm just adding on, as I said, on those huge drawdowns. But it requires a lot of emotional work, because oftentimes, you know, like Amazon, when Amazon was falling and all the news, oh, Amazon is done, you know, Google is done. Now we have the chat GDP or GPD. Google is done, maybe Google goes to zero. Like, you read all sorts of news that are completely crazy. And if you let yourself to be influenced by those news, it can end up poorly for investing and trading. So I think just really having a plan, sticking to the plan, and do your own due diligence is the most important. And now also not reacting to the FOMO. Like, a lot of people are sitting on cash these days, and now you see the tech flying, and I can imagine many people are FOMOing into trades, and they feel bad that they are not in trades. And I know for a fact, because as I mentioned already, a lot of people reach out to me and say, oh, I wish I would be at least in some trade, you know. So just like, don't FOMO, it's not over. There will be always a chance to rebuy. There will be always a chance, you know, to buy maybe another stock if the one that you wanted rallied. And as Archna said, it's great to actually get into these long positions with options. That's great, because you feel like if you struggle with FOMO, you're like, okay, I sold a put on, let's say, Amazon. So I got my premium, and now I'm getting paid for the time. So you don't have such horrible FOMO if you're not allocated in Amazon. You say, okay, if it gets there, I will get the 100 shares. If it doesn't, I will sell a put again. So you kind of feel like you're always in the game. But again, like, having your plan, write it down and stick with it, and don't pay attention to the news as much, because they are there to scare you. That's it.
That's good. Thank you so much. Yeah, ignore the noise, and absolutely focus on your plan and what works for you, and don't follow people blindly into trades. That's another big one that we get on Twitter as well, or social media in general.
Oh,
yeah. Yeah, absolutely. Caleb, could you please share with us your mindset? We'd love to hear that.
Yeah, sure. I think once again, it's really important to kind of bifurcate between, you know, long-term investing and trading. And so I think, you know, I did talk earlier about how I'm, you know, selectively long some of these 3x leveraged ETFs. Thankfully, I have an opportunity to do this full time and spend, you know, as much of my waking hours as I possibly want looking at my charts and trying to manage risk. And so for me, that's something I'm able to do. And it sounds like a lot of people on this call as speakers are able to do that as well. I think for people in the audience, the best trade right now is to not trade at all. You should really just be focused on long-term opportunities in the market. When you have companies like Google, the last I checked, for Google to get back to all-time highs would require a 70% gain. And so if that takes 3 years or 4 years, you're essentially securing a 16% annualized return. And when you think about the S&P 500 historically providing about a 9% average annual return, I'm telling you right now, Google can provide 16% if it takes 3 to 4 years to get to new all-time highs. And so if you look, and you know, Amazon is basically the same thing. Microsoft, basically the same thing. And so these are fantastic companies that have been severely repriced because of a higher interest rate environment. Valuations have contracted. That's exactly what we expect to see in a rising rate environment. And so now, you know, we talked about it a little bit earlier with earnings. I really think that patience in this market is the way to go. So I would really just implore a lot of people on this call not to be trading and to be looking more long-term towards the future about what opportunities you want to be holding over the next 3, 5, 10 years going forward. What are those high conviction stocks or assets that you genuinely feel comfortable to hold if the market does go down another 30%? How much cash do you have right now? Those are all the important questions that you should be focused on, the important dynamics that people should be focused on. And so once again, I really do think generally that the best trade right now is to not trade at all. And again, if you have cash in your portfolio, if you've been successfully managing risk in 2022, I kept telling investors, whenever we would go on these bear market rallies, I kept saying this is another beautiful opportunity to reduce risk. No one sold those no one sold those RIPs. Not no one, I don't want to say that. But if you did, you had an opportunity to raise cash. And right now in the market, we have a 4.3% yield in money market funds, right? I mean, that's an amazing little opportunity right there. And so, I think for me, that's really how I'm really trying to approach things. Even as I look at my trading account right now, the positions that I'm holding are fairly insignificant relative to my long-term portfolio that that I've already DCA'd, and I still have a shit ton of cash left on the sidelines. So really for me, that's where I get wide-eyed in this market right now. And I think, it's great to hear people talk about these kind of shorter term dynamics and what they're really looking at in terms of swings or options trades and things of that nature. But I'd really just implore people to stay long-term focused. And, the lower these prices go, the more wide-eyed you should be getting.
Thank you so much. Great advice. Great, not the word advice, great thinking that you share with us.
I'm totally fine to call that advice. So
okay, thank you. Okay, everyone's afraid of that word. So yeah, but that's really great. Just thinking and insight and advice. So thank you. Tom, would you like to add? And you're always very wise when we talk. I love everything. You know so much, and you're very humble. So if you could share with us your thinking, because you're very knowledgeable.
Yeah, I appreciate that, Rosanna. I've got a simple risk metric, and it's, can I sleep at night? If I'm turning and tossing all night, if I'm waking up early just in a nervous panic to check what prices are doing, I know that I'm overexposed. And there's been times in my life where that's been the case. I just took on way more risk than I could stomach. So I've kind of matured over the years, and my main thing is I always want to keep dry powder. Because there's always going to be opportunity somewhere. You guys have heard the phrase, there's always a bull market somewhere. So no matter how bad things look, there's always an opportunity. And I want to have capital at my disposal to take advantage of those opportunities. So I'm never all in. Nothing ever looks so good that I have to just pump all my capital into it. So it's really just, I'm a big DCA guy. I like to dollar cost average in. I like to build positions over time. I like to trim positions when the market action dictates that I do so. But yeah, it's really simple. Can I sleep at night? If I can sleep, great. I'm positioned correctly. If I can't, then I need to make some adjustments.
That's simple. I like it. It's great. Can you sleep at night? That's great. I'm gonna think of that one next time for sure. Is there anything I missed on anything that you wanted to share, Archna, Leah, Caleb, anyone that I missed that you'd like to mention that's important for us to hear? Anyone? Okay, thank you. I'd like to go around and have everyone please tell us how anyone can stay in touch with you, and if you offer any services or anything for anyone. Your input today was very valuable, and we appreciate all the time that you contributed to being part of this great space. Archna, please tell us about your Substacks.
Yeah, I write a daily Substack, which is called Index Income .substack.com. And it's basically, I look at the SPX and come up with an options trade now that we have zero DTE options there. So just doing fibs on SPX and ES daily, come up with either a put credit spread or a call credit spread for cash flow. Like yesterday, last 2 days, we've been having the volatility came down and we had choppy markets. So selling put spread over there at 38.75, 38.70 yesterday, zero DTE, $5 wide. I got $1.50 credit and it expired worthless, kept the credit as profit. So those kind of trades I come up with pre-market, and that's the Substack that I have. There are days when there are no trades. That's also fine. But if you can make, $150, even 3 days a week, each week, 3 days a week, it's good enough cash flow. This is per contract. So that's what I do with my Substack.
Awesome. Thank you so much. Leah, could you please share with us?
Hi, darling. Can you repeat the question, please? Hello?
Sure. Yes. Sorry, I couldn't hit the mic button. It was like
same
weird.
here.
No, tell us how anyone can get in touch with you. Do you offer any services for anyone? I think you have coaching, correct?
Yes, I do. I was a marriage counselor and intimacy coach for over 10 years. And in 2020, I started trading and pretty much trading daily since then. And I love to help people with the psychology around trading. And that's what I focus on now. And that's what I help traders with, especially how to manage your emotions, how to be more in ease around trading, how to achieve your goals, not act upon those emotions, how to manage them. So yeah, I do coaching for traders, and I am rebranding my website just right now in these days. So it will be up very soon. Thank you, Rosanna.
Yes, you're welcome. And you're writing a book on trading psychology, correct?
Yes, I have a free ebook that's coming out. I finished the ebook. I'm working on the design. It will be mistakes that traders make, emotional mistakes that traders make, and that can ruin your account. So that will be out on Twitter hopefully next week. It's a work in progress.
Wow.
Yeah.
Awesome. You move fast.
Yes.
That's awesome.
Yes.
Good for you. I'm excited to read that one. I think that's an essential reading for everyone. Thank you so much, Leah.
Thank you.
Kate, you're welcome. Caleb, please tell us, I love your Substack. I'm going to repeat that again. Okay. Love your Substack. Great macro and market analysis. And you're a great writer too. So please tell us how everyone can stay in touch with your Substack and more.
Really appreciate that, Rosanna. Thanks for the compliment. That means a lot. I started my Substack in May of 2021. We're already getting to 3,200 free subscribers. We've just been growing like bananas. It's called cubicanalytics.substack.com. I named it Cubic Analytics because I take this 3-pillar approach to markets, analyzing macro, the stock market, and Bitcoin. So in each newsletter, they're free, coming out every single Saturday. I literally don't miss. You can expect to get a piece of information, some charts, some commentary, overall analysis on those 3 dynamics. And then if you're really a chart junkie, really a market junkie, and you want to get my deep dives, I do a weekly report for premium members. That also comes out every Sunday. And so I'll have a big announcement coming out either this weekend or next weekend about a new series that I'll be sharing and launching. So I'm really excited to come out with that. And definitely just check me out there. But I would even just encourage everyone, just go sign up for the free newsletter. Give me some feedback, give me some criticism, share your ideas and comments with me. I'd love to hear what you guys are thinking. So check me out there, cubicanalytics.substack.com.
Love it. Well, over 3,000. Congrats to you. That's amazing. Well, that means a lot because that says a lot about it. Well, I love it. So it's great. So everyone check Caleb out for sure. Let's bring that to 5,000 soon. And Tom, my favorite, I'm going to tell everyone, my favorite stock and options site, BarChart. And Archna, I know, uses it. Leah, I believe maybe Caleb as well. We all love BarChart. I think it's a fantastic site and they're always improving. And I can't believe that's possible. I use it for screeners. I use it for options data, for seeing gap ups and gaps down, all that. So I'd like you to please tell us, Tom, about yourself and what you have available, please.
Rosanna, appreciate the love. That was an incredible speech there. Thank you. Yeah, no, Leah and Archna love BarChart. We just got Caleb on recently as well, so hopefully he has some thoughts and observations as he gets more into it. The great thing about BarChart, we actually give a lot of our data away for free. So if you guys don't want to pay, just come over, check it out. I think you'll find it pretty useful. You can even get a free trial, play around with the more advanced features, and decide if those are needed for your particular strategy or the way you manage your money. But we have a lot of things. We've got unusual options activity. We've got charting. We've got political insider trading. You want to see what Elon's doing with his Tesla shares, you can do that on BarChart. We've got screeners. I know Archna loves the screeners. Rosanna, I'm pretty sure you do too. We've got a mobile app. So again, a lot of this is available for free, guys. Come and check it out. Let me know what you think. DMs are always open. I love to get feedback. And, the great thing about BarChart and the reason why we've been around for 20 plus years, we listen to people who use the site. We love feedback. We love constructive criticism. Let us know what you think. We'll make changes that make sense. So, yeah, let me know what you guys think.
I'll say something. The best feature that I have encountered in BarChart is the flip charts. It's like, you run screeners and, many platforms do that. I have scans even in my Thinkorswim platform, but then looking at all the results in one go, looking at all the charts at one go, it's much easier. Even if I have 50 stocks show up in a screener, it takes me 5-6 minutes to just go through those 50-60 stocks, because that flip charts, it's just right there. Just use that flip charts. I am actually taking all my scans, slowly building it on BarChart from Thinkorswim, because seeing all at once makes it easy to figure out which stock to actually trade. It's reduced my scanning time a lot, actually.
Love it. I love all I love that as well. And then the highest implied in volatility, the unusual options volume, all that options stuff is great. But screeners, and Archna and I have been speaking about BarChart screeners, how I use it extensively as well, Tom. And I did find quite a few stocks that way. AMKR, as we discussed recently, that was through BarChart. And I did it through fundamentals screening as well as technicals. And I love the features in there. There's just so many features. And the most important thing is that you're very approachable. And to be able to speak with like BarChart directly and give you feedback, and you take that and you're always improving, is significant. And, I try with my business to try and stay in touch with my customers, because it's so important. Feedback loop is very important, and giving your audience what they need. And you're very much in touch with the end user, knowing what they need as traders, option traders. And that's very valuable to me. And my website, rosannaprestia.com, I do have an educational platform where I teach options. We have a whole team of people. And Archna, I'm so honored. Archna's part of our team, and she's amazing at technicals and just options trading. And we're going to be using BarChart as the platform to teach from. And the charting is fantastic, and the options data. So I just wanted to say that we're going to be using BarChart for our site. So we're very honored and happy and pleased about that. Tom, how's that sound, Tom?
I'm not going to complain about that, Rosanna.
Okay, good. Awesome.
And before I know, I'm not sure how much longer we're going to go, but before we sign off, guys, I want the audience tell all you guys, 2023 is going to be an interesting and challenging market to navigate. Make sure you're following Rosanna, Caleb, Leah, and Archna. They put a lot of great tips and advice on their accounts, and that you're going to find useful in trying to deal with all the things that come up. So please take a moment to do that.
Thank you so much. I second that. Please follow Caleb, Leah, Archna, and BarChart as well. And check out BarChart. Like as Tom said, it's free to a lot of resources. It's worth just checking it out. And check out Caleb's Substacks. It's and Archna and Leah. It's free. And give it a read. And we're all here. Look, ultimately, we're here to help each other. Okay. I don't get paid for this. None of us do. We're here to spread information and to help one another, and that's the goal here. So I hope I'm sure everyone agrees with that. So thank you so much to everyone on this panel for taking your valuable time to share your valuable insight with us. And thank you to all the listeners. We appreciate all of you for making this happen. So thanks so much. And until next time, have a great day and happy trading. Risk management, though. Take care. Bye-bye.
Thank you, Rosanna.
Bye. Thank
you.
you.
Bye.
Thank you for listening to the Rose Show podcast. Please visit rosannaprestia.com for more episodes. See you soon.